Hello, I'm Eric Gorman, Regional Vice President for CCIM Institute and President of Beer Realty Group. Welcome to today's webinar, Commercial Real Estate Opportunities in Regions 10 and 11, the Resurgence of Secondary Markets. We're happy to share this webinar with everyone in the industry today. For CCIM Institute members, this is just one of the major benefits that are designed to help you adapt and thrive in 2021 and beyond. Joining us today is CCIM Institute Chief Economist K.C. Conway, CCIM CRE MAI. K.C. is going to discuss the factors that are bringing secondary markets and Zoom towns back to the forefront, including the current trends that are driving them and how to best set yourself up to tap into commercial real estate opportunities in our regions. Please feel free to ask questions throughout using the question and answer tab. We'll be answering as many as we can at the end of this discussion. And if you're experiencing any technical difficulties, please use the chat feature and ask for help with that. The recording and accompanying presentation will be emailed to registered attendees. K.C., welcome. Thanks for joining us today. Now I'll turn the show over to you.
Sorry about that. Can you hear me now? All right. Had my mute on for a minute, so let's just jump on in here. It's great to be with you. I'm doing it from outside. Hopefully the birds and the airplanes, everything in the neighborhood are quiet. Let's jump in. You got a lot of territory to cover with you guys. So kind of my opening perspective I've shared with some folks is I walk every day on a little greenway trail near my home, and every day I find some new piece of wildlife. And so I ran across this pretty ugly, crazy looking horn-nosed kind of beetle. Thought I'd take a picture of it and use it for something in a presentation. So I figured it's about as ugly as inflation. So I'd use this to explain that we have a new pest or annoyance out there, and it's called inflation. So I'm going to talk a little bit about that before we get into the markets, because it really is a dominating story that's going to be with us all this year and into next year, and I think maybe beyond, but I hope not. We saw the past 2 months, we've had CPI come in hot at 5.4%, but we've seen even hotter things. We've seen PPI at 6%. We've seen construction costs pretty high, running in the 7 to 12% range. And even Jamie Dimon has said, look, at inflation is here to stay. So it's not just a theory, it's a reality. A little bit of historical perspective I thought is important is, if you think about it, it's been 4 decades since we've had CFOs that have had to deal with real inflation and deal with something called raising prices, and how you do it and how you manage it and how you balance it with what then follows, which are wage increases. So it's going to be interesting to see how it plays out. And it's not just, things like certain commodities and lumber and this transitory language that the Fed wants to use. Look at some of the biggest price increases and inflationary increases in the last months and over the summer. Used car prices are through the roof, up 45%. Essentially, you're at new car prices. Look at gasoline, 45%. I filled up here in Atlanta today. I'm heading to Florida. It was over $3 a gallon. That's $1 more than we were at a year ago. And the July's and June's 5.4% CPI was the highest reading since September of 2008. So quite a while. So I put a couple of historical slides here. This is the 10-year Treasury. And it's been so long since we've seen what happened, 77 to 81. But I think it's worth reflecting on, because these changes in the 10-year Treasury and inflation occur very, very quickly. And the Fed is always behind the curve when it comes time to cut or raise, and they are again. But look at there from 1977 to 1981, it was just barely a 4-year period where we went from a 7% to a 15%. We tried to have taper tantrums in 2013 and 18, and when we tried to push the 10-year above 3%. The difference is why it went back down is we didn't have inflation. So we have inflation, and I think we can tantrum all we want, but I think the rates are going to move on us. This is probably one of the more complex slides that I have, but it's one of the most valuable. I'd get a failing grade from the communications department at a university center for this slide in a presentation, but I like to give you the detail and something to take away of value. So starting on the left there, In 1941, we went on the gold standard. In 1946, the Fed got its first of its two mandates in the Employment Act of 1946. And that was full employment because we had all the GIs returning from war and was transitioning to a peacetime economy. So they wanted the Fed focused on how do we get everybody employed. Fast forward a little bit and get to the summer of 1971, Nixon takes this off the gold standard. And then in 1978, with the Humphrey-Hawkins Act, the Fed got its second mandate, which is price stability, because we had runaway inflation. It was starting. And so look at the inflation from 1% in 1964 to 14% in 1980. And as many of you that are around, like me, I was a teenager in high school when the prime went to 21%. I was just graduating from high school, and I was in a developer family and saw the devastation. I think it's important on the right, up there at the top in the orange shaded box, to understand what caused us going from 1% to 14%. Think back, the 1960s, we had really significant deficit spending because of the Vietnam War. We went off the gold standard. In 73, we had an oil embargo and an energy shock that is very similar to today, what we could call a COVID supply chain shock. Just as the oil embargo and the energy prices were a shock to the economy and inflation, so too has been COVID and the supply chain disruption. Then we went off, we had Nixon try to put a Band-Aid on it with price controls. And then if you notice, most government data only goes back to the mid to late 70s. And it's because the data was so bad and the Fed relied on it so much that they don't want us to ever go back there again. So that was then, and here's today. We have deficit spending worse than what we had in the 1960s. We have the Fed using its balance sheet like Nixon was using price controls as a tool to kind of paper over inflation. And it didn't work for price controls, and it's not going to work for the Fed's balance sheet. At some point, they got to quit spending $122 billion intervening in the market every month and ballooning their balance sheet to now that's over $8 trillion. That's doubling the balance sheet since pre-COVID. Pandemic, we have no clear plan regarding the future of work and how that works and what it does for asset prices. And we have the supply chain disruption, which is just like the oil embargo. So when you put the convergence of those things together, that's where why I'm in the camp that I'm very fearful that we are more likely to see a 1970s inflationary event than just this barbecue sauce, my polite term for BS, transitory inflation that the Fed talks about. One other item on inflation that if you look at that's relative to commercial real estate, I rely on a resource called ENR, Engineering News Record. They have a constructionomics section. It's a very affordable resource. You can subscribe to it for under $100 a year. And you can see the latest readings on construction and building costs. Look at building costs up 12% in the month of July, year over year. These numbers keep doubling. Look at where we were back in April at under 4% and around 6%. Now we're at 7% and 12% respectively. They have a city index on these costs, so you can translate it down. Philadelphia and New York are all part of those cities that they cover. I really encourage you to look at it. This is really important. It's important if you're working with tenants that are looking at lease renewal versus move decisions, because you got costs to redo TIs. It's also important for clients that are saying, maybe I'm going to move out of the city and I'm going to go to the suburbs, and they really need help doing, a move decision. Am I better off? What's the cost benefit of leaving the city and my rent down there versus moving into new space and the cost of TIs and moving? This is one I found interesting because when the Fed talks about transitory inflation, they think it's just a few items that are going to go back in the Genie bottle, and it's not. We need to look at systemic. So this is one that was done on the cost of building a new home. And I thought instead of looking and focusing on things like lumber prices, let's look at some other things. Look at paint. So all of us have probably spruced up some painting around our house or need the exterior painted. Paint's up almost 70%. Look at appliances. Good luck getting them. You're up 65% or more. My recommendation is if you're selling a house here in 2021, sell it without the appliances, because you may not be able to get appliances to the new home that you're moving, or you may be able to flip them for a higher number later on. So it is more systemic. This isn't transitory. Another thing I look at, this is by ENR, and they look at from contractors and survey contractors and say, Are you kind of stable in building each of the different property types, or you have to see more activity and more interest in having developers have you bid for projects? And so it's a little busy here, but look on the far right side. For each of the property types, whether it's office or distribution or multifamily or retail, they all were green or blue arrows. They either were improving or stable activity. So even offices. Now fast forward over to the left and look at where we are today. Commercial offices, it's declining activity. Multifamily, declining activity. So this is telling us whether it's supply chain disruption, whether it's rising costs, something's going on and it's adversely impacting the ability to build and deliver new products. So what that means for us as CCIMs is that existing assets are going to be more desired and probably the alternative, and new construction is going to be harder to deal with. For banks and lenders, they better be paying attention to cost overruns, because these kinds of cost increases, we may not be getting the kind of rent increases to offset for the value differential. I think particularly so in office. I think we're going to see a major repricing of office rents in urban markets versus suburban markets. And so if you've got new construction, you might see 20, 30% construction cost increases and rents be the same or less. And what does that do to the value of the property when you have a higher cost and not an increased NOI? All right. We're talking about what's happening with markets and secondary markets and urban markets. So many of you might recall back at the beginning of the year, I talk about the moving reports, the moving migration reports that come out from U-Haul and United Van Lines. And they're a precursor to the census data that we've been getting here this year. The precursor to, hopefully COVID was ending. Now it's coming back. Now we're worried about a lot of things. And what you can see is through last year in COVID, where were people moving? They were moving inland. They were moving south. They were moving away from the expensive coastal markets in California and New York and New Jersey. So you can see on the left where we were moving. You can see on the right where we're moving away. So for your two regions, 10 and 11, you can see why we all know the story about the migration out of New York, particularly to suburban areas around New York or into Connecticut or upstate into the Albany region or Coxsackie type of area, beautiful area north of New York. But Virginia and Pennsylvania, you've actually had move-ins. You're in the middle. It wasn't a complete fall off the cliff. On the U-Haul data, a similar situation that we saw. We saw a movement really inland and south. We saw the Intermountain region, we saw the southern markets, and we saw the move away from Maryland, from New Jersey, from Illinois, California. Those are the big states where the migration was going out. And we know a lot of the reasons why. And now we're trying to figure out, is it going to stay that way or come back? So let's start to dig in now to more updated data. We've got the census data. So this was the initial census data release, a good map here showing where the most population migrated over the last 10 years. So you can see that Intermountain region and you can see the southeastern states. So, places like Idaho and Utah and Florida, all with 14, even the DC, Maryland, you guys are in there, 14+% population growth and migration over the last decade. You can see the only 3 states that lost population were Illinois, West Virginia, and Mississippi. So for all the bad media news that they bring on your Northeast region and New England and all of that type stuff, you didn't go negative. You still have positive population growth. So maybe it's not 10 or 14%, but it's solid in the 3 to 6, 7% range. But more of that is to the areas around the big urban markets. It's outside the central core of Philadelphia. It's outside the central core of New York City. So we just got a batch of data that I've been slowly trying to digest in between some court cases and a lot of other work. But on August 12th, we got a deeper dive into the census data. I'd encourage you all to look at it because it digs down to the MSA level about what changes occurred, in race and the voting age of population, occupied versus vacant housing, all of those type of issues. So that's a new fresh batch of data we just got here this month. I encourage y'all to look at it. I'm going to try to be doing an update piece on that. I just haven't been able to do that the last week to 10 days. So another thing I want to encourage you to look at, particularly for your suburban markets, for your secondary markets in the regions 10 and 11 geography, and that's what's happening to middle market companies. So these aren't the small businesses. These are the middle market ones that have at least $1 million in revenue and up to 100 million in revenue. These are the proven concepts that are growing. And what they're finding is they can't quite make it or expand in the big urban markets, but they are in secondary markets. And this is called the National Center for Middle Markets, NCMM. It's housed at Ohio State University. It's sponsored by really credible companies like Cisco and Grant Thornton. And this was their summer report for the first half of the year. And what these companies are saying is their outlook, even before we had all the news about vaccinations or the Delta variant and still being uncertain. And they said, look, they've had over 8% growth in the last 12 months. And in the middle markets, they also said over the next 6 months, they're expecting 66% of them are expecting to see more growth. And that the growth they're projecting for the balance of this year and into next year is almost 10%. The reason I point this out is these middle market companies are the ones that account for leasing and transaction activity in commercial real estate. They account for over half of it. This is your target market. Paying attention to what they're saying and where they're going is really going to be predictive for you, particularly in your suburban and secondary markets. All right. There's one I want to call out that came out recently that used to be a survey and analysis I relied on and thought was pretty credible. And it was CNBC's annual rankings of the best states or the top states for business. And so it was pretty predictive, pretty reliable. I agreed with the methodology, but this year they injected a new metric. And you'll see the red arrow on the left side there at the top called life, health, and inclusion. Mostly it's inclusion. This is the ESG DEI metric, and they put a huge weighting on it. And so places that got a relatively good inclusionary rating tended to rise really high in this year's rankings. And it overrode a lot of fundamental economic and business metrics. So you guys have Virginia. Virginia, congratulations. You were rated #1 for the second year in a row as the top state for business. I think you have a great economy and all, but with all due respect, I think it lost a lot of credibility. If you look at some of the scores and metrics there, it just doesn't add up. It doesn't add up also when you look at that they had Florida ranked #17. Give me a break. I think the states like North Carolina, Utah, Texas, Tennessee, the metrics are pretty good, but look at on Texas. They had a 49th. They were second worst in inclusion rankings. Now look over on the right. You have markets like Vermont, Rhode Island, Maine, and where they ranked, and we're going to talk about these, but Vermont, here's the distinction. You guys were ranked the most inclusionary or most inclusive, best ESG DEI state in the CNBC's best states for business. Now, that was news to me, but take everything you can get. But I want you to be aware of a lot of these new rankings that are coming out are changing methodologies, and they're injecting more political and social type metrics to override or dilute fundamental economic and business and real estate metrics. And I think that's a mistake. I think you keep them divided. You have two different scorecards and you look and balance those out. But I called barbecue sauce on this year's CNBC's top states for business. Virginia, take everything you can get. You're a great market. I believe you're a top 10 market. But objectively, I'll be the one to say I wouldn't have had you guys as #1. But you can look at your metrics and make your own judgment. Take everything you can get. Congratulations. All right, what I will tell you to look at that I think is more objective, and when you're talking with clients or you're putting packages together, is Site Selection Magazine. Most of this is free. The CCIM Institute has a relationship and a program with the site to do business where you can get a lot of additional data as part of being a CCIM. So let's start with New York here. New York, you're the 3rd largest GDP in the country, and you got no respect. Where do you rank really well? Well, you rank really well in terms of higher education and research type development. Think of the caliber and quality of your universities, and it's not just minting MBAs, it's a lot of other stuff. So you rank 2nd in the country on that. And you rank #9, believe it or not, in lowest industrial electric power costs. So people don't think about low electric power costs for New York. It's very important if you're doing fintech or Bitcoin mining or any of those other type things. So New York, I don't think you deserve the low ranking that you got in the CNBC thing. And, objectively, here's the facts and here's the metrics that are objectively looked at without a lot of political and social injection into the process. Here's another one. I don't often get a chance to talk about the Port of New York because we all get inundated with the data and the headlines of LA Long Beach or some of the southern ports like Charleston and Savannah. But here's what's important. The New York port, You're the largest U.S. East Coast port in terms of container volume movement, and you've been doing a very good job through COVID with all of that. You handle almost 4.4 million containers, which is great year to date, annualized here for 2021. Savannah is on your heels. Port of Savannah and Georgia Ports Authority will probably exceed 5 million containers by the end of the year and next year. But you're a very important port market. You're a very important gateway. You flow a lot of stuff down into Pennsylvania, and Pennsylvania is really the inland port to really the whole Northeast and up into Canada. Look at your growth change, over 30% growth. One of the problems that all of our ports have that you're handling very well is Port of New York. You've had a 45.9% increase in empty containers. So you got to figure out how to manage these, move them around, not have them clog up what's coming in. It further shows how much import activity is coming into our country. So congratulations, New York. You have the top port on the East Coast. You should talk about it. It's driving your industrial. I'm on a board of directors for Monmouth. We made our first big investment in New Jersey, a major asset for FedEx. So very, very important market that filters all the way down into Pennsylvania. Speaking of Pennsylvania, look at where you rank. You're the 6th biggest GDP in the country. And look at where you rank well, just like New York. Look at number 4 in terms of higher education expenditures. And this spills over. We're going to be in Pittsburgh here in the fall. I hope many of you will be joining. I hadn't been to Pittsburgh until about 5 or 6 years ago, in probably 20 years. And I was shocked at the transformation in Pittsburgh. I think many of you, if you go, you'll be shocked. You won't believe that you're in, quote, an old steel city. Google go out to the Bakery Square area, look at the downtown and the vitality, look at the financial services, look at the downtown universities. It's an incredible story with affordable and lots of skilled workforce. Same thing on power generation. You're in number 14th in terms of lowest electrical. So a lot to be proud of in Pennsylvania. The other thing is Pennsylvania, you're an energy state. So what's playing out on energy policy and fracking and all that kind of stuff directly impacts Pennsylvania. And so you need to be paying attention to that element as well. New Jersey, you're the 8th biggest economy in the United States. You get a lot of hits on a lot of things in terms of fiscal health. You're ranked worst in the country. In terms of state business tax climate, you're ranked worst. You know the issues, they're in the headlines, you're battling them. So, you can generalize, but look at what you're good at. You're number 20 in the country, so you're better than 30 other states. Again, in higher education, research and development. Our REIT is based in Homedale, New Jersey. We occupy in the former Bell Labs headquarters that was retrofitted into what's called Bell Works. It's got the largest photovoltaic solar roof system in North America. Generates most of our electricity. There's a lot of cool stuff. It's a very green state. People that haven't been up and driven around, you'd be amazed why they call it the Garden State. It's not just because of Madison Square Gardens or whatnot, but it really is a really green state. And a lot of if you get out into the areas, you'll see that. So New Jersey, hold your head up. There's a lot of things you're doing right. You have a lot of challenges, but let's work on all of those. So here's was the CNBC's ranking on New Jersey and what I wanted to call out to you. So look at the life, health, and inclusion score. So New Jersey's rank, came in number 26, but look what they did. They said from an inclusion state, you're number 10. You're doing the best job at it. And again, but they give you very poor rankings on the cost of doing business. You can see some of the other metrics. Workforce, you're very strong on. Number 11, you have a lot of very skilled, talented workforce that commutes or goes over or benefits into New York. Look at your infrastructure. This is also part of the New York Port Authority and a lot of what moves into New Jersey and its port system and access to capital. So there's a lot of good subcategories within that report. So don't be dragged down by the fact that your number 26 ranking doesn't compare with your top 10 GDP ranking. Virginia. So you made the top ranking, but you're the 13th largest GDP. So think of this, the 13th largest GDP, not even in the top 10, is ranked number 1. And look at the metrics. You only have one top 10 category, which is, if you look at it, ranking workers' compensation premium rate increases. So that's kind of obscure. But when you look at business tax climate, or you look at R&D, or you look at workforce readiness, the briefcase indicator, how do you get a top 1 ranking unless they give you a really high in an inclusion ranking? So I'm all for and glad that you got this, Virginia, but when you look from the outside, you look at credibility of these type of rankings, we have to dig deep sometimes, and the site selection magazine is the one I go to for the most objective data that doesn't have any politics. So you're a good economy, but I think many are scratching their heads when you look at Texas got its worst ranking. Florida didn't even make the top 5, 10, or 15. And when you look at metrics like small business formation and population growth, these are the fundamentals that you think about from a top state to do business and actually things following. So I think everybody recognizes Virginia's a good state, but there's a lot of disagreement whether it ranks number 1. Here also in Virginia, you can kind of see some of these. Look at your inclusion ranking. So if you hadn't gotten such a great inclusion ranking, and you got a strong one in education. So it was education and being inclusion or a good ESG state that really drove your score to a number 1. But if you look at all those other metrics except for workforce, they really weren't even in a top 10 area. So you can look at it objectively. Maryland. So Maryland, you're the 15th biggest economy. Again, look at your like New Jersey and New York and Philadelphia. 5th in things important like higher education and R&D expenditures, a lot of good schools. Number 12 in terms of a number of other metrics, but low in terms of like state business tax climate. And you understand that, the challenges that you probably have clients that are working with. And then, your fiscal health. You have issues there that you gotta tackle and put on your radar and figure out how do you deal with those when you're working with businesses and tenants that are moving around or looking at whether they stay in Maryland or they move somewhere else. Connecticut, 23rd largest GDP in the country. Again, doing very well in research and development, but pretty low in all of the other kind of metrics. And some of these but you need to be aware where these type things rank, because this site selection magazine data is looked at by a lot of folks that do site selection work. It's looked at folks and businesses outside the US that are looking at reshoring business. So you really want to know these metrics and these ratings and these rankings so you can figure out how to defend or mitigate them in any kind of a marketing package, or if you're pitching a property or working with a client. Delaware, number 42, believe it or not, 13th top ranking in state business tax climate. Maybe that's why a lot of companies incorporate in Delaware. Obviously, we know there's some reasons. Maybe having the president's home and his weekend getaway there might well, I guess, yeah, that's more Rhode Island, but anyway, they're all close together. You guys, all of you in the New England make together, put them all together as a one big state. But anyway, so Delaware is important. So one other metric I want to throw out there, make sure that you're aware of that you can do inside to do business, but be very careful about it. And I'm raising it because I'm getting a lot of calls from clients and companies that are doing site selection work, or they want site selection analysis done. And one of their top 2 questions after costs is about crime. And they don't want to move from one place that has tough crime statistics to another. So I'm going to show you 2. In New Jersey, you're going to hate me, but I'm going to start with Chicago. So I recently did Region 7 and we at Chicago covered. And you can see in here, you can break out a site to do business. The statistics that if you have a rating on any category, total crime, murder, rape, whatever, over 100, 100 is the base average for the United States. So you can see Chicago with a number, particularly in terms of the robbery index over 300, and you look at the murder index at over 300. Not great situation. Be aware of this. Be aware that we can answer this question of clients that are asking you to do or incorporate some crime statistic analysis in a site selection or a site analysis situation. Just be careful. You do not pair that analysis in any way with any demographic data, because then you are probably guilty or will be brought up on redlining charges or an attack. So keep it separate. Do 2 separate reports. If they ask me for one, I'll do one that I just call a crime statistics analysis report and not put anything else with it. And then when I do the other site selection report, I'll do the other data with demographics and property information, but I will not have this data in there. But be aware of 2 points. 1, clients and people doing site selection are asking this question again. They don't want to move to a place that's worse than where they're leaving. And number 2, site to do business is an incredible tool. that doesn't just do retail for us, but it also does things like this. So you thought Chicago was bad. You know who's worse? Look at Newark, New Jersey. Look at Newark, New Jersey's rankings in terms of the robbery index, over 419. So if 100's the base for the United States. So Newark, if any of you that are doing work in Newark, you're probably going to be doing work with more clients and companies that are exiting out of Newark or exiting elsewhere in New Jersey or in the Northeast region, or maybe completely out of the region. So I threw Chicago in there because we all think Chicago's the worst, but be aware of your own backyard. Newark, you've got a lot worse profile on crime statistics. So along that line, I want to really put a pitch in here for Site to Do Business and CCIM Technologies. So we need to know that we have this great resource at CCIMs known as CCIM Technologies, and they do a lot of things for us. And they're going to be in Pittsburgh, and they're going to be revealing a lot of new stuff that I encourage you to attend, either in person or if they've got the webinar opportunity, Zoom capability. But they also have a Site to Do Business concierge service. So if you can't do it and you think you want an analysis, I want you to be aware that one, they can do that and assist you. Number two, that it's not just a retail tool. It's not just a retail property. I'm using Site to Do Business and doing story maps for low-income housing tax credits. I'm using it for self-storage. I'm using it for office site selection and analysis. It's much deeper in its analysis than thinking just retail. So there's where you can reach out to them. Please go to their program in Pittsburgh. I can just tell you, as Redshoe Economics, I'm a small little company. I don't turn in a court report. I don't do an expert witness report. I don't do a site selection or economic impact analysis without a Site to Do Business analysis and a story map. And we have one of the great talents in the Institute, Caitlin Peterson, who will be sitting for her CCIM exam in Pittsburgh. She actually won the contest a couple of years ago that CCIM had for people on doing story maps. So you can find this talent out there, but if you can't, go to Site to Do Business or CCIM Technologies. All right, housing is very important. We understand what's going on, especially as we deal with the Delta variant, especially as we deal with rising home prices and a lack of affordability. You need to know that the rent forbearance program was extended this summer into September, and I think it'll get extended further. We know the eviction moratorium is an issue and is being extended, and who has power, and state Supreme Courts weighing in against the federal courts and mandates on it. It's a mess. If you have clients that are in multifamily, I would note two things. We're probably going back to more or extended rent forbearance and eviction moratoriums as the Delta variant spreads, case count rises, and we go indoors as the weather gets bad this fall. Two, if you have clients that have thought they're going to recollect all of the rent that had to be forborne, or that that it's going to end, they're probably mistaken. I think there's going to be a rent forgiveness instead of rent forbearance, and I think there's going to be a means testing that'll put something in place, like if the renter had a household income of under 50,000, it's forgiven. And so what do landlords do? Landlords need to be really doing robust analysis, engaging CCIMs to help them with this kind of what if analysis, and that's what CCIMs do very well. On office, so this will be coming up. Many of you are in regions or states that have major office markets, New York and Philadelphia, DC, etc. So one of the tools I look at is, I've shared with you in the past, is the Castle Systems Back to Work Barometer. They update this every month. If you go back to February, we were at under 25% that were going back to work, even as we were rolling out vaccinations. We got up to almost 34% here this summer, and it has fallen back to 31% with the Delta variant spreading and companies making decisions that they're going to extend remote work even longer, which I think gives us a risk it could become more permanent. So look at this. You can look at some of the major states and locations. Dallas is performing pretty well. You can see New York. You're not even at a quarter that have gone back to work. For all of the news and everything about New York opening up, you're still at under a quarter that have actually gone back to work. So what Castle does is, all those electronic key cards that we have to get in and out of buildings, they get that data every minute for every building that has their technology or system, which is pretty extensive. All right, one other thing that I want to point out for you in an analysis, and I think this is going to be important in places like New York and Philadelphia, and that's to look at who is occupying your office space in your urban markets. So I did this analysis for Chicago. It was a lot of work in the Region 7 presentation. And my point was, a big city like Chicago that has major crime statistics and it has a high cost of living, it's not fiscally balanced, has a lot of negatives against maintaining an office there. And yet it's probably going to do okay. And the reason is, if you look at their top 10 office occupying users in downtown Chicago, look at who they are. They're accounting firms, Deloitte and Accenture. They're financial services like Discover, and insurance like Allstate. They're entities like Walgreens and again, E&Y. And what they're doing, the workforce that there are business analysts, data analysis, business process management. Those are very hard to replicate skill sets that are very dependent on the university systems and the MBA programs. And they're showing no inclination they're gonna give up their office space or move away. So Chicago could be one of those big markets that moves contrary to others, like San Francisco or the perception of New York, where they lose a lot of office space, or Philadelphia. So do some work. I can't do all these markets, but this one I thought I'd put in there to show you a big market that has negative perceptions, where its office market may actually do pretty well. And I think, this is what the question mark we're gonna have to do for places like New York and Philadelphia and DC as well. All right, I wanna pivot to logistics real quickly here. So this is our new paper that we put out. We're back to doing the insight papers after the dry spell last year in COVID. We did this one on last mile logistics to build on the Ward Center course that the Institute released in January. It's getting a lot of good coverage. So if you haven't looked at this, I know we're all busy, but logistics is important. We've got really good coverage. The CCIM communications folks, Larry Guthrie and all have done a great job. We've gotten coverage from institutional real estate with Globe Street. We even got Freight Waves, which is a global entity for logistics and shipping around the world. So these are important pieces I just shared with you. You can use these to stay in touch with clients and forward them. It's another value add for your designation. We are really trying to do a lot, whether it's podcasts or content or insight papers, to make sure you guys have some good content to share with clients or be informed. In the logistics arena, this is in the Ward course. This is some of the logistics and last mile resources that I track on a daily, weekly basis. Most of them are free or cost very little. So if you want to stay up, or that's your focus, here's the cliff notes to knowing what I know or try to stay up with. We just put out in the new Sire magazine a piece, my mid-year outlook on the economy, titled "What a Difference 6 Months Make." I think, Larry, if we rewrite this for the end of the year, we'll say again, what a difference 6 months make. I fear that what we were achieving here over the summer could quickly reverse. So many potential issues, and it's not just inflation, it's not just the COVID virus, but we have a lot of headwinds coming into the fall. And I really do fear that where things are going and things like the Federal Reserve, canceling last Friday its Jackson Hole meetings in person to do them virtual, was a really horrible message by our central bank, saying they're trying to tell us the economy is doing great, they're seeing great job growth and they want to see it. Yet then they send a message, we're too afraid to get together, we can't even wear masks in the beautiful outdoors of Wyoming, Jackson Hole, Wyoming. Horrible, horrible message. My personal opinion that I put social media out on was this was a stunt by the Fed to give them cover to not pull back on their taper and the balance sheet and interest rates. They want more cover to keep the money going. And again, you see Congress got another $3.5 trillion that's coming. So with that, there's what going. We'll conclude and take some questions. I have a special needs son, Luke. He just turned 11. And over the summer, his big thing that he wanted to do is go to our favorite neighborhood restaurant that was finally open. And he loves root beer, and just have an ice cold root beer and have some time with me. And then his buddy, his special service dog, Charlie the Beagle, is next to him. We actually traveled and went out to a resort. I'm going down to Orlando, Florida this afternoon to be at the Florida Realtors Conference the next 2 or 3 days and speak. I'm vaccinated, I've had COVID, I still wear a mask, we can function. But anyway, as I was getting ready for this and a number of the presentations here this month, my son Luke and then Charlie barked and agreed. The advice they wanted me to give you here as we still have a month, another month of summer to go, September 21 or 2, is it's still summer. Take time off, enjoy a cold root beer or adult root beer, and a day at the pool. There's going to be a lot to worry about this fall. In the meantime, you know you have certain issues in your region of the country, but it doesn't mean the end of the world. If you look at upstate New York, if you look at Connecticut, if you look at getting outside of New York City, you can see the tremendous outmigration. Not everybody moved to Florida or North Carolina. A lot moved around in the Northeast region of the country. You have great logistics, great ports in New York and New Jersey. And I think that if we did an office analysis on Philadelphia and New York, like I did in Chicago, we might find that maybe there's more of a bullish case than a bearish case for office. But I think I've been in the camp all along that I think the urban dense markets that are dependent on public transportation or just urban dense and in cooler weather markets are gonna really face a challenge. This is a watershed time for those assets, and that we're I'm bearish on those. And bullish, I'm on the suburban and secondary markets. And we're seeing that in the numbers and leasing activity. I just was on a program down in Florida, down in Miami. Miami has almost no sublet space. It's having net office absorption increases. Different states and geographies are moving to a different drumbeat for a lot of reasons. But companies are looking at smaller chunks of office space in the suburbs near their talent pool. And big tech and financial service companies are agreeing to let employment and certain employee and employment disciplines work really anywhere they want. They may adjust their salaries for a cost of living. Facebook and the tech companies from the Pacific Northwest have said, we're going to allow almost anybody to work remote if they can make it work. But if you move from Seattle to, say, Boise, Idaho, and the cost of living is 25% less, we're going to adjust your salary. We don't know the models that are going to emerge for office yet. We're still in a really deep discovery phase. So don't panic, don't overreact. And remember, office is always that asset class that is worst or last to correct and last to go into the doldrum because the leases are generally longer. And big credit companies aren't going to bail on their leases. They'll try to sublet or they'll honor them. But in the meantime, look at what they're doing in smaller chunk space leasing out there. So with that, I will stop screen sharing and see if we have any questions, Eric. So I see there's a couple in the Q&A.
All right, yeah, thank you, K.C. And we do have a couple questions. First one's from Rob Salt. How skewed is data for Virginia as a result of the contribution to data from the companies in Northern Virginia versus the dominant secondary markets like Richmond and Hampton Roads?
So great question. It is skewed. They don't give as much emphasis to the port and the southern part of Virginia. And those are very, very important to the contribution. But obviously Northern Virginia, the proximity to DC, how it clicks off of that, it overwhelms, say, Richmond and the other parts. So it is skewed to Northern Virginia.
And another question from Jesse Cortez. He asked, how should we go about doing the office analysis for our market? What resources to use to get some of the data that you would use? And I think you touched on it with STDB, but maybe you could go a little bit deeper into that.
Yes, so very important. So some large markets, some of the big commercial brokerages have really good data on that. Some keep it proprietary because they don't want to know who all their tenants are. But some of the look at some of the large brokerages. CBRE does a good office report. JLL does as well. The other one to look at is, believe it or not, our site to do business data. It's an incredible tool. It may not tell the employers, but it'll tell you the numbers and what's happening there. And then the third one you have to kind of look at is look at the major companies. You know, for example, in Philadelphia, you know the industries that are in the downtown market. You also have a lot of government downtown in Philadelphia. Look at who they are. And then if there are companies other than government, go look at their public websites, look at their 10Q and their 10K. And I did that analysis and looking at what are the industries, then what are the major companies in Chicago that are there, who has the most workforce. And then I went and looked at their public filings or public information that they have and looked at statements or numbers that they provide. The public filings on the public companies is very important. You know, if you've got a Home Depot, or like in Florida, you've got an Auto Nation, you've got a Carnival Cruise, you've got, Disney, you can go and they'll talk about what they're doing. It's a bit of work. There's no one stealth source to go to, but triangulating kind of those three. Sometimes your economic development department in those states or in those MSAs, that the chamber and whatnot have some of that already put together because they're talking to those tenants and clients about that activity. So those are 3 or 4 ways, but it's some old-fashioned elbow grease work. It's not an easy go to one site and get it all.
Thanks. K.C., one question I have is, and you touched on it, is that there's a move away from the center city urban markets, right? That there's a move for those office occupants to go away and either downsize or become suburban, which if you're a suburban landlord, great. But historically, it's been those urban centers that have been the drivers of the economy, the head of the body, so to speak. And the body or the suburban piece always is done well if the head is healthy. As those things change, are we looking at a paradigm shift of how we think about economics in a region, or what happens when you have those large centers, dense centers that also cost a lot of money, that then lose potential revenue because of businesses fleeing? What then happens to the overall regional economy? Because the body will suffer if the head gets sick.
That's a very great question that we should be asking more of. So think of the infrastructure. Also in those big urban centers is a lot of our infrastructure. So I'll pick on Atlanta. I'm here in Atlanta. So we have our only level 1 trauma center hospital in the entire state of Georgia is in downtown Atlanta. And it's financially on not solid ground because of this. The bonds for our public light rail system known as MARTA, the Metro Atlanta Rail Transit Authority, is in serious trouble. The Airport Authority and its bonds. So what we need to worry about is as these companies leave and exit the core city, also what exits is some of the financial support for critical infrastructure. And that's why you know it in New York. Look at how the Fed had to intervene last year and were buying and putting on their balance sheet New York authority bonds, whether it was the Port Authority, the Water Authority, the Sewer Authority, to keep those critical infrastructure items liquid, no pun intended, and alive. And so what it also means is we're shaping up. This is an opportunity for CCIMs, huge battles on property tax appeal. And so as these companies flee, those downtown office assets maybe are not worth the same amount. In the vacancy rate, you need to factor in the sublet vacancy number to get the total. In some of these markets, like you look at a downtown Houston, half of the office space is available for sublet. And it's a combination, not just of COVID, but energy and a lot of other things. You go to the suburbs, these assets are leasing up or selling at incredible numbers. So the surrounding communities are looking at this as an opportunity to increase tax assessments on older suburban business park office assets that, you know, maybe were worth well less than $100 a square foot. And now I'm seeing cases where they're doubling the property tax assessments. I'm doing a case, Eric, you're familiar with in Metro Philadelphia, Montgomery County and Bucks County, where the property tax assessment has just gone nuts. It's a total bifurcation from the reality of what's happening. So it's a real concern. I don't think we can adaptively reuse office like we can retail. You can't just make it, you know, residential. You can't poke holes in the concrete flooring without jeopardizing the structural integrity of the office building. You don't have enough elevators and elevator cores to probably make it all work either. So office is going to be really, I think, a challenge. What I think is going to happen is companies will come back. They may use more office space or the same, but they're going to have fewer employees. So if you have a lower density ratio, you're going to pay less. And I think there's a major repricing coming in urban office buildings. I don't think the vacancy is just going to collapse and you'll see 50% buildings, 50% vacancy in buildings. I think what you could see is 25 to 50% reductions in rents in downtown office buildings, because now if I can only put one employee per 300 square feet instead of one per 150 or 60, why would I pay that exorbitant rent? I think the other thing we're going to see is that the common area maintenance costs are going to go way up. And so they're going to look for tenants to pay more of that. We've got more maintenance, we got more COVID, we've got all the capital expenditures to upgrading HVAC with HEPA filters, and every tenant wants its own isolation zone and whatnot. All those add to the capital cost and the maintenance of the office building, which takes away from the margin. And so that's going to ultimately play out in what happens to the cap rate to adjust with that risk of retrofitting those. And so it's just easier to move employees to the suburbs or secondary markets they're happier. You can find smaller pockets of office space. You maybe don't need 20,000 square feet in downtown. You maybe only need 8,000 in the suburbs, and people rotate in 2 days a week and they reserve it and they have client meetings. That's a whole neat, different cost structure. And if employees move outside of expensive areas to more affordable ones, that enables employees to do like what Facebook's going to do. They're going to lower their cost of wages. That's how they're going to combat wage inflation, by saying, we'll let you work remote, we'll give you all the tools, we'll buy you a computer, we'll buy you a new office chair, but we're going to adjust your salary down to the cost of living to the market that you move to. So we don't know what we don't know yet. All of these forces are at force, and we don't know, are they temporary? You know, maybe we should use the term the Fed, transitory, or are they permanent? I'm in the camp, this is a systemic change. For office, this is very similar to what happened when the GIs returned from World War II in the late 40s and 1950s. And they said, we're not going to live in downtown. We're going to go to this new place called a suburb and develop regional malls. And for the next few decades, that was the business model that drove real estate. I think something different's happening here. And for the big cities that have huge debt burdens and huge bond burdens, we really need to be looking at that piece of the equation and have those elected leaders thinking about it. And when we're advising clients, we need them to be thinking that what the taxes are today and what the expense loads are today on these assets are probably going to be materially higher. And so how do you factor that into a buy or sell decision is going to be very important. And again, that's what we do as CCIMs. Those are our skill sets. So I'm bullish on the suburbs and secondary markets. I'm very concerned, if you want to translate that to bearish, on the big urban markets. But we got to see how this all plays out. I think the biggest tentacle and dot that's not being connected is the fiscal issue.
Yeah. Well, I appreciate it, K.C. Thank you. Unless there's another question, I think that as always, you've given us a tremendous amount of information. It's almost like trying to drink from a fire hydrant sometimes. So the good news is that this has been recorded, and a copy of it will be sent out to all the participants that are registered. And if you're not already a CCIM Institute member, you know, or a course participant, take a moment, sign up for the e-newsletter at ccim.com and stay informed. You'll get complimentary webinars and this one, as well as other professional development opportunities. So I appreciate the time, and obviously the insight that you provide, K.C., is unmatched. It's fantastic.
So Eric, I'll give you a little offering for your region, since you guys 10 and 11, you guys are hosting in Pittsburgh, our global conference. I encourage everybody to show up. We're going to have some space. I'm coming in early and I'm staying over a little bit late. We're going to have a room, and we'll have a red shoe shine shop or help you find red shoes if you don't have them. But I'll make myself available. And if any of your CCIMs from region 10 or 11 are there, find me or reach out to me or Beverly Keith, my partner in Red Shoe Economics. And we'll set aside an extra hour just to kick issues around, maybe look at doing some work on helping New York or Philadelphia do that same type of office analysis I did on Chicago. So I'll make myself one-on-one available, no charge, in Pittsburgh to meet with regions 10 and 11 while I'm there.
Awesome. Well, we look forward to it, and I will take you up on it.
Great.
Thank you, everybody, for attending, and appreciate everybody jumping in. K.C., and have safe travels down to Florida. And if there's nothing else, thanks, guys.
Thank you.